Surging energy prices are driving almost all markets in 2022. So what is it that's driving energy prices so high, particularly in Europe, and what are governments trying to do about it? But also as investors, is this presenting us with some opportunities? Now this video is brought to you by News Over Audio, or NOAA, which brings you the best in audio journalism. So let's look at the European energy crisis and how it affects the stock market in a bit more detail. Let's begin with why energy prices are so high. This is the European energy mix, and the one thing that really stands out is that since the 70s, coal has been falling sharply as a proportion of the energy supply, and gas has been taking its place, and that's because it's seen as a less polluting energy source. Nuclear rose to a peak in 2000 and it's been falling since then, and renewables have been increasing recently. But you can see there's a huge dominance of fossil fuels for generating energy in Europe. That still remains the case. Now the problem was that when Russia invaded Ukraine, it supplied a lot of that gas into Europe, about 37% in fact. And Europe couldn't just substitute another supplier, partly because of the way it was physically delivered. That's because a lot of the gas comes into Europe via pipelines. So that's what PL stands for here. And these are the grey shaded regions, with Russia in black at the bottom, then the rest of the world, and then finally Norway in light grey. Now with a physical pipeline, you can't switch the source because that's kind of buried in the ground. Whereas with liquefied natural gas, it comes in ships which are brought to port, and you can substitute one supplier for another very easily. However, you do need infrastructure to take the pressurized cold LNG and then regasify it to turn it into usable natural gas. And unfortunately, Germany doesn't have a lot of infrastructure to do that, and it's heavily dependent on Russian gas. So it'll take a long time for that supply to come online and substitute for Russian supplies. Now, higher gas prices mean higher electricity prices, because as we saw, gas is seen as a cleaner substitute for coal. And if we look at 2021, for example, you can see that the orange region is the amount of electricity generated in the UK from natural gas. While there are other sources, such as nuclear and wind, but also to fill the gap, the interconnector from France in pink, you can see that gas is completely dominant. So if gas prices increase, so does the cost of electricity. And gas is a global market. So for example, here you can see the import volumes by country for the largest 5 countries in Asia compared with the largest 5 countries in Europe. And that's by import volume in 2021. Notice how even the smallest of those 5 in Asia is bigger than the largest in Europe. So that's Taiwan and Spain. So in order to compete with Asia and to get the LNG tankers continuing to come to Europe, Europe's had to pay very high prices to compete. Now, one of the benefits that the UK has at least is that it does have a lot of infrastructure for LNG regasification. In fact, it's the second largest infrastructure in Europe, second to Spain. So this supply problem will eventually be solved by creating more LNG ports and infrastructure, but it's going to take a while. And it's no surprise that when gas prices started to fall over the last few days, Russia suddenly decided to switch off its gas supply via Nord Stream 1, its major pipeline. And while the excuses so far was that it was something to do with maintenance, now they've come out and said that it's actually about its invasion of Ukraine and the sanctions being lifted. So increasing the supply is now explicitly contingent on reducing those sanctions. And it's looking like this war between Ukraine and Russia is going to be very protracted, so that's not going to happen anytime soon. So if you look at the Dutch front month futures contracts for gas, that's what you can see beneath me. Those were starting to fall. You can see those big falls recently, and then suddenly Nord Stream 1 was switched off, and you can see the prices started creeping up again. So while there isn't an alternative supply of natural gas into Europe, it is looking like it's going to be a very cold winter with potential supply shortages, blackouts, and economic pain, but also hardship for households, particularly those who are struggling to pay their energy bills. To research this video, I used this story from News Over Audio, or NOAA. It's an audio app, so I can use it when I'm out and about, and it combines the best in journalism from a variety of sources, such as The Economist, Bloomberg, and The New York Times, and many more. Noah's editors, such as Rahul here, then take stories and organize them into series so that you can see the same story from multiple perspectives. This is what the app looks like, so here are the editor's picks, but we're going to search for something on energy. And here are lots of series to do with energy. Viewers of PensionCraft get a special offer from Noah where you get a premium monthly subscription where the first 3 months are absolutely free and you can cancel anytime you like. To learn more about that, just look at the link in the description below. So what are governments doing about these high prices? Well, in Sweden and Finland, they've come up with credit guarantees and loans, but these are to utility companies. Remember that these companies will often buy energy in the futures markets, which require margin, and that margin in turn depends on the volatility of what you're buying. So as volatility spiked, they've had to come up with much larger margin payments. So large, in fact, that it's threatening the liquidity of the companies. Now, if these utility companies fail, that could be a systemic problem, not just for the utility sector, but also for the financial system. And the Eurozone, which you can see from this tweet from Ursula von der Leyen, is completely committed to combating the weaponization of energy by Russia. She says Putin will fail, Europe will prevail. And the proposals they're using to combat Russia's energy war are reducing electricity demand at peak times, perhaps by asking nicely, but also introducing a price cap on that pipeline gas, which supplies much of Europe. They will help vulnerable consumers and businesses using revenue from energy companies, and they will help electricity producers with those liquidity challenges, as we saw in Scandinavia. Now, Germany's already announced a revenue cap, which is quite interesting because it's different for different sectors. So for each different energy generating technology, a revenue specified in euros per megawatt hour, which plants are allowed to keep. Any excess they have to surrender to the government. And the payments based on the difference between the market price and the revenue cap, which you can see is different for different industries, such as renewables, nuclear, coal, and gas. Then the money can be used by the government for something else, such as subsidizing vulnerable consumers. Now you can see they've had some fairly radical brainstorming in the European Commission. I particularly like this one from Javier Blas, where they're going to scrap the futures market price in the Netherlands, the TTF price, and replace it with an Asian futures market price plus €1. So whatever Asia's going to pay for gas, Europe's going to pay a tiny bit more. And that way they can keep competitive and not enter a huge price bidding war, which can get out of control. Now, some people think these fiscal payments will themselves be inflationary and actually exacerbate the inflation problem which has gone along with this energy crisis. However, I don't agree with that, because if we just think about vulnerable households, simply ensuring that they can pay their energy bills will not make them rush out and start spending that money. It's not as if they're going to have a huge excess amount of cash to do that. And of course, the most wealthy households won't get those payouts. So really it depends on how those government packages are targeted. Now let's turn to the economic impacts. And here Europe was very similar to the rest of the developed world. Initially there was an oil and gas supply shock, primarily caused by Russia, but also the economy coming back on after it was switched off during the pandemic. That in turn resulted in very high energy inflation, which has now spread to a broader range of services. And as a result of that, central banks have been tightening policy in order to stave off entrenched inflation. And that in turn has been bad for the equity market, particularly growth stocks, where higher funding costs have a negative impact on the company. And although it's taken a while, we also are now seeing slower growth. So for example, if you look at the UK and we look at a forward-looking measure of GDP growth, which is called a Purchasing Managers Index, this was published today. The PMI index ranges between 100 and 0, and if it's above 50, it indicates expansion, below 50 is contraction, and notice how recently it's crossed that 50 dividing line, heading south. The grey bars here are GDP, and you can see that we're probably headed for a deeper recession here in the UK. But PMI indices elsewhere, such as China and the US, are also heading south. Now, if you read the text of the PMI report, it has a lot of interesting detail, and in particular about where the pain's being felt. So now it's switching to consumer-facing services, such as restaurants, hotels, travel, and other recreational activities. And activity there is collapsing under the weight of the cost of living crisis, because higher inflation means people have less disposable income to spend on those recreational activities. And of course, business services are also coming under pressure given their own rising costs. Now, you might think the biggest negative effects would be on German manufacturing companies which use a lot of energy, but in fact, there's a nice Spanish story here in El País which talks about examples of local companies having to shut down because of those energy prices. So a smelting company which makes ferroalloys, a ceramic tile producer, and a steel furnace, all in Spain. So if you're redecorating your bathroom, those tiles could become more expensive due to the higher energy prices. And in the UK, something you wouldn't necessarily think of as being very energy intensive, a pub, can also have its energy prices soar. So this is Tom Kerridge, he's a UK celebrity chef and he owns a pub. And here he's saying that his energy bill's increasing from 60k up to 420k. That's an increase of 600%. So many pubs may become unviable as businesses due to this high energy price. So it's not the obvious sectors which are being affected. It's a very broad effect. So this is going to be a huge crisis until energy prices come down. And surging energy prices have even entered the world of daytime TV. Here's a program called This Morning in the UK, where they have a kind of Wheel of Fortune game where you can win a prize where they pay your energy bill. Now, as investors, we'll also think about the market impact and whether this has produced some opportunities. A huge impact has been in the currency space. So here you can see the strength of the euro, sterling, and the yen versus the US dollar. All three have weakened significantly over the course of this year. Now, for investors in US assets from those three countries, this has been good news because the assets are worth more when you convert it back to your domestic currency. So the US sell-off hasn't been as bad for them. But the drawback of a weaker currency is that it increases pass-through inflation. If we look at equity markets, Japan is really the only one which hasn't sold off a lot over the course of this year. The S&P, China's CSI index, the German DAX index, and the FTSE 250 in the UK are all down by around 20%. And with the announcement that the Nord Stream 1 gas supply would be switched off, those markets have sold off more, particularly the ones in Europe. And if we look at the UK market in particular, broken down by sector over the course of this year, there are no surprises that the oil and gas producers have come out best, but also a lot of defensives like healthcare providers, waste and disposal services, but also pharmaceuticals. And the companies which have come off worse, a lot of them are in the retail space. So retailers are down by about 35%, but also household goods and home construction, the kind of stuff that you'd cut back on when there's a cost of living crisis. So the key thing is that this has produced opportunities, but you have to be very careful. What is it that's sold off over the short term which will recover, and what kind of things might not recover at all? So if you look at the valuation for the S&P 500, this was the huge bear market rally that we saw, which has now largely reversed, but now we're seeing valuations look much more reasonable. We're still not at the very long-term average of the forward price to earnings multiple, but it's certainly getting a lot cheaper. Now, will the S&P 500 recover? Of course it will. It's just a question of when. Will a single pub chain recover? Maybe not. So you have to be really careful distinguishing between what will and will not recover and what has had its price depressed temporarily by a fall in risk appetite. In conclusion then, the winter of 2022 is going to be really tough. For some families, it's a question of not being able to heat their house. That's unless the government intervenes and comes up with some kind of fiscal program which helps them out. Many businesses may also stop being viable, so we could see a pickup in the default rate. If it gets really bad, we could see load shedding, where people's lights switch off, and some companies have to be shut down. On the upside, this is creating value in some markets, but you have to discriminate between companies which are temporarily depressed in price, and of course that's also true of global indices which will recover, whereas single companies may not. Also, it's always good to remember that this too shall pass. Things will eventually improve. It's easy to get caught up in the doom and gloom, but this is exactly the kind of environment in which you find opportunities. So for example, I'm going to carry on drip feeding into my equity in my core portfolio. So I think it is going to get worse before it gets better, and it's going to be a very difficult winter in 2022. Some companies are not going to make it because of the higher energy costs, and hopefully governments will step in to help the most vulnerable households get through this crisis. But remember, this will pass. Eventually things will improve, and there will be some opportunities in markets as a result of the fall in risk appetite. Now, don't forget our offer from News Over Audio. You'll find a link to that in the description. And as always, thank you for listening.